Good morning. Good morning.
Is that Richard?
Good morning.
Is that Richard Dixon? Good morning,
That's
Richard.
me.
Good morning. Do you want to start
Beautiful
it?
day, isn't it?
Yes.
You guys want to start housekeeping?
Thank you for participating in today's meeting. If attending in person, please do not connect to Zoom or teleconference while in the room, and please silence all devices. If translation is provided, click on the globe at the bottom of your screen to select either English or Spanish. Public comment will be taken after each item. If you're in the auditorium and wish to comment, please use the iPads located in the lobby or complete a blue speaker card as available. If you need assistance, please find a South Coast AQMD employee. Speakers may be limited to a total of 3 minutes or less for all agenda items. Times may be shortened to ensure all speakers can be heard. A countdown timer will be displayed on the screen for each public comment. More time will be allotted for Spanish translation that is not simultaneous. For questions or issues on making a public comment, please call the public advisor at 909-396-2432. That's 909-396-2432. Please adhere to the speaker time limit and treat others with courtesy, civility, and respect. Failure to do so can result in your mic being muted or you being removed from the meeting. Be aware that this meeting is being recorded. By participating, you authorize recording of audio and visual content presented during the live event and consent to subsequent use of the recording in the public domain by South Coast AQMD.
Thank you. Good morning, everyone, and welcome to the Hybrid Investment Oversight Committee meeting of Friday, December 12th, 2025. Jenny, will you please take the roll?
Supervisor Hagman, Vice Mayor Almos, Vice Mayor Almos, Board Member Padilla Campos, Richard Dixon,
Present.
Sarah Meacham,
Present.
Jill Wynot,
Here.
Chair Cacchiotti.
Here.
We have a quorum.
Thank you, Jenny. We'll begin with our first item on the agenda. It's a discussion item. I don't think any motion is required. Discussion of our report on investment activities by Sujata Jain, our Chief Financial Officer. Sujata, good morning.
Good morning, Chair. Good morning, members of the committee. Sujata Jain, Chief Financial
morning.
Officer. This item is to report the cash balance in the LA County pool surplus and the special purpose investments. As of the end of third quarter, which ended on September 30th, 2025, the balance was $1,723,400,342.51. The composition of our investments are 89% in pool surplus and 11% in special purpose investments. The earning rate for September 30th, 2025 was 3.51%. Happy to answer any questions on that.
Committee members, any questions? Supervisor Hagman.
Thank you, Mr. Chair. I guess Wayne, more than anything else, it's always been an issue for us in government because we always want to have our reserves, we want to have planning, we like stability, but we generally don't receive as much income off those investments as it does as we're competing for investment into programs or inflation into development. So if I'm making 3 or 4% on an income, but inflation is going up 4 or 5, if I start a project 3 years from now, that's more on the investment side. I'm just wondering, why do we have so much cash reserves? What's the?
So Supervisor, a lot of these are state grants, which the state gives us in advance, like Calmoya, our CAP money. So we do have money up front, and then as we spend them, we, as the grant keeps going, we are making those expenditures towards incentives, et cetera.
So these are 2 and 3 year holds, or how long have we been running a balance?
Yeah, these grants come in and they usually get spent over 2-3 years.
So we could be down to 0 in 3 years if we had no more money coming in.
If you had no money, but thankfully it does keep coming.
Keeps coming. I'm just saying, yeah, it's the same thing with my transportation authority, or even on, my county. It's like we have these projects, we start off at a certain amount, by the time they actually spend the money, they go way up, and then we don't keep up but we're getting some investment. Thank you.
Thank you.
Committee member, yes, Sarah.
I've known the district for quite a while, and the LAIF balance has been at 40 million since the LAIF limit was 40 million. And LAIF now allows 75 million. So I think it would be advisable. And in this environment, LAIF is going to have a higher yield than the county pool, and it's also additional diversification. And it's not a large, it's a very small amount considering the overall size of the portfolio that the district has. So I would ask that we consider maxing out the LAIF balance to get that higher yield on that little amount, but more diversification away from LA County. Like it's a very small amount, but the optics of it to max out LAIF when it's higher yielding, I think are good. And so, and obviously, the district's comfortable having money in LAIF because it's had that $40 million balance for a very long time.
Yeah.
Yeah.
Thank you, sir, for that comment. And actually, we did exactly that. We went to LA County and increased our, level to 75 million. And this is a September report. So as of October, we are maxed at 75
Oh,
million.
fantastic. Thank you.
And we are taking advantage of the higher yield.
Jill, go ahead, please.
Good morning, Sujata. On page 2 of the report, there's a chart that shows the composition by maturity range, and it's 1 to 60 days, 61 days to a year, and then over a year. Over a year is 30% of the total portfolio. And so I was just wondering if it could be possible to get a breakdown of that, because I noticed some of the funds don't mature till 2032 or quite a long time. So is it possible to break that up to maybe 1 to 3, 3 to 5, and anything greater than 5 years? I
Yeah,
think that would be good information.
we can do that for a future report.
Sure.
And it's just the LA County's report that comes to us. We'll have to sort of work with that. It's not very Excel friendly, but we'll do it.
Okay, thank you.
Thank you.
Members, Vice Mayor Brenda Almos, any questions at all? Welcome, Vice Mayor's here. Just a couple, Sujata. And, I'm going to a little stick over to our supervisor on my right, Mr. Hagman. On page 4, I admire Mr. Hagman because every time I look at the comparisons of earnings, San Bernardino beats us. So we're at 3.51 and they're at 4.36, almost a full percentage point ahead of us. Kurt, what's the secret out there?
We're just that much better than LA County. So feel free to switch it over anytime.
I remember we brought this up when Supervisor Antonovich was here about switching over, and we never did. I've been just watching. We've been performing well, but kind of always behind San Bernardino a lot lately.
Mhm.
Is there any thought of?
So we have, we look at that obviously since I present this graph. And what we did is we look at a 10-year trend.
Right.
And we went back and looked at 10 years, and actually all the counties are in the 2% range over that period. So yes, San Bernardino lately has been higher than various counties, and every county probably has their own strategies. But if you look at a longer period, which we just looked at yesterday, went back 10 years, it's they're all pretty much hanging at 2%, 1.98% or so.
Sujata, if you can, what you looked at yesterday, can you provide us as one of our agenda
Yes.
items? I'd like to see that.
Yes,
So you're probably right. I remember before, early on, 8, 9, 10, 11,
yes.
fluctuated. But I
Mhm.
just noticed the last several reports or a couple of years, San Bernardino has been doing very well, maybe
Yeah.
because Kurt's there.
Yes, I certainly can.
And one more question I have, in case anybody else does, is, let me find it here, the exact page for you. I was going to ask this question on page 3.
Yes.
One of our notes is maturing next month on the 26th. Well, a number of them. When I went down the list, it's several. I saw U.S. Securities, $160 million. That's a lot. Now, this is where your strategy comes in. That was a great return at 4.25 when you got it. with the rates going down, what are you going to do now? What is your strategy? What is PFM's strategy?
So like so that matured or is maturing in January.
Right.
But meanwhile, there was other investments that had matured in September. So we had reinvested in October. The highest rate that we were getting was a 3-month. And then we also diversified and went into LAIF, which is still at about 4%. So, you know, we've done that, and come January, we will again reinvest. And yes, there was a rate cut yesterday. Feds did do a 0.25 rate cut. So it will affect, you know, everything, but we've been trying to maximize whatever rates we've been getting and, you know, otherwise staying with the pool. So we will see what the pool's rate is. And because even they probably had a lot of maturities that came up in November and December and reinvested.
And just for our public and our other members, when you examine this in January or maybe later December this month, give us a thought process you and anybody else on staff or a consultant would do before you make that decision.
Yes, sure. Currently, we have about 285 million in special purpose investments, and then the rest is in the LA County pool.
Okay,
Mr. Chair.
please.
I agree with you. If all the county pools are doing about the same, I don't know why you wouldn't diversify. So, you know, they have maybe 2 or 3 different pots of money they compete against themselves.
Sorry, Supervisor, I didn't get that.
Well, the original chair, the question the chairman brought up was, you know, why don't we switch to San Bernardino? Because we're doing better the last few years. But could you do part in LA, part in San Bernardino, and just diversify? If over a long period of time it's not much difference, you still have that ability to maybe have those gains. One county does better or the other.
Yeah, I think LA County, if they are the treasurer, then they their policy is that they are assigned and then they keep all the money. They only let us diversify with LAIF.
Committee members, any more questions? Is there any public comment? I see no hands raised. Anybody in the auditorium? No? Staff, did staff want to make a comment, Wayne?
I was just talking with Susan that we will have a discussion to try to address the thought about increasing the diversification amongst the counties.
Okay.
I want to better understand LA County's approach, and then we'll come back and report to the board, to the committee.
Great, thanks a lot. See no public comment, we'll move to item number 2, and that's the cash flow forecast. Sujata, again, please.
So this item is a projection of our cash for the next 3 years. We're required to do this cash flow every 6 months. The next analysis will be on at our June 2026 meeting. Our lowest cash balance will be in October 2028. It'll be 548.6 million. We can invest in special purpose investments, about 75% of that, which is approximately 411.7 million. Currently, we have, like I said, invested about 285 million. Happy to take any questions.
Committee members, any questions?
No.
None? I say, okay, let's, is there any public comment on this item? None here in the auditorium, any online, Wayne? None? Okay. Thank you, Sujata. Great work as always.
Thank you.
Item number 3 on our agenda is, and again, no motion required, is financial market update. And that's Mr. Montoya with Institutional Sales Relationship Manager, PFM Asset Management. Robert. Welcome in person today.
In person, indeed, and I'm excited to be here.
Good.
I was telling Suhad, I drove in and I've done these presentations, what, 2-3 times already?
Yes.
Didn't realize this whole back room existed. Like, it's so big. So But good morning, everybody, and happy to be here in person. Good to see all of you. I wanted to preference today's presentation by saying that due to the Fed meeting that happened yesterday, the last few days, some of these slides might be outdated. So I will try my best to provide in more up to date as we go as of this morning. So more of the question for today is, how did we get here? Where are we going? And just kind of a perspective in terms of the market. You can go to the next slide, please. And stop there. Yeah, perfect. So let's begin. Let me go to my notes here. So just to kind of get started, right? So the Fed ultimately carries a dual mandate that includes the unemployment rate and inflation. This slide speaks to the labor data with payrolls on the left side and the unemployment rate on the right-hand side. The non-farm payrolls breakdown here gives insight into which sectors are adding jobs versus which ones are cutting jobs. It includes final figures for all 3 months in this past quarter that ended Q3. The average for the 3 months is around 29,000. And on the right-hand side with the unemployment rate, you see on there for August, it was at 4.3. So the unemployment rate had risen to 4.3 in August. It was correctly projected to hover around 4.4%. That was the rate in September and still remains the rate right now through 2026, just kind of reinforcing the thought that the Fed's challenge of balancing the employment risk against inflation goals. Big takeaways here is the dual mandate is still complex as the labor market momentum softens, which goes back to Fed Chair Powell's highlighting the September cut as a risk management cut at the time. Job creation from June to August or really in the summer did hover around that 29,000, as I mentioned, which is well below the break-even pace needed to keep unemployment steady. While sectors like healthcare added jobs, most other sectors did see a decline. Job gains, as stated this week from the Fed, have slowed. Interestingly enough, I was reading this morning why, and I've gotten this question quite a bit, why healthcare is the one adding the most jobs. If we look around in our population, I used to be an investment advisor for individual investors, and they always said, oh, there's always, the boomer generation's getting older, the money's coming. Same thing with jobs and healthcare, right? There's a lot of people getting older. There's a lot more need for nurses, for medics, and things like that. So that can account for that. And on the latter half, when you see like wholesome trade, manufacturing, things like that, you can equate that to inflation, the rising cost. But we'll talk a little bit about that more in the next few slides. Next slide, please. So in terms of core PCE, which is the Fed's preferred gauge of inflation, it's slowed down the impact of inflation. Really what we see on here on the graph is the dark line is the actuals, the dotted line is the forecast, and then the shaded area is sort of a range. Price pressures have remained elevated. Core PCE inflation currently is around 2.8 year over year, but it is expected to climb to 3.1% in the first half of 2026, mainly driven by tariff-related goods inflation and non-housing services before gradually easing before that Fed's 2% target. On the right-hand side, we listed out inventory drawdown, margin compression, exception and exclusion, shifting trade patterns. These are all things that have kind of delayed the impact of inflation. If you go back at the beginning of the year, and I might have spoke to this then, a lot of companies say like autos were buying cars in advance. I believe Apple bought a ton of iPhones before tariffs coming to fruition. There was a lot of deals still going on. If you're local to the area, I know there's a lot of new builds around here as well. You can see a lot of these builders stocking up an inventory. But again, all of that stuff is starting to draw down. You're starting to see the bleeding of tariffs and the rising of costs in a lot of areas, especially for us common folks, which I'll make a reference to that a little bit later on in the presentation. Next slide, please. In terms of the consumer price index, so CPI for all urban consumers increased 0.3% on a seasonally adjusted basis in September, after rising 0.4% in August. This is according to the BLS, or the Bureau of Labor Statistics. Over the last 12 months, all items increased to 3.0. That's the number you see on there for September, and that's seasonally adjusted. Note that September CPI data collection was completed before the lapse and appropriations, meaning before the government shutdown and even after the government shutdown, it's been a little bit hard to gather a lot of this data. Going into this past Fed meeting, it was very interesting to see how and where the Fed was going to pull information to make these decisions. I think in the end, again, unemployment was the one real reason why there was another cut. But again, going back to CPI and what you see on here, price increasing. So there's just some more detail in the specific areas that we're starting to see a price increase, food, shelter, energy, and that sort of stuff. Next slide, please. So now into the consumer. So I'm going to spend a big deal of talking about consumer spending, retail savings, because there's almost like an underlying story going on. In terms of the consumer sentiment and just kind of the consumer overview, I want us to pay attention to the bottom left-hand side, the personal savings rate, and also the credit card balances. For personal savings rate, you can see on there CPI inflation has risen, right? Personal savings rate has also gone down. There's almost two sides of the story, and you'll hear me say this a lot moving forward on this presentation. I was actually in a conference the other day where they were speaking about how there's two halves to the American story, right? You have the normal day-to-day middle-class people who are starting to see the rise in cost. They're not really driving the economy right now. A lot of that's coming from the upper 1% who still has a lot of disposable income, who's still spending. And that's really where you kind of see two views in terms of where we're headed and what we're seeing. In terms of the U.S. credit card balances that you see on the top right, my second point on here, credit card balances do fluctuate. They've gone up and down. You can see GDP has begun to slow a little bit or remained flat. And in terms of credit card balances, that's continued to go up. I wouldn't be surprised if that were to go up again after this month. We are in the season of giving. A lot of people like to run the credit cards, so the data may be skewed next time we meet in terms of that, in terms of that sense. Next slide, please. Now, in terms of the consumer sentiment, so consumer sentiment did lift 2.3 index points in early December this month. This month's increase was concentrated primarily among younger consumers. Overall, while views of current conditions were little change, expectations improved a little bit, led by a 13% rise in expected personal finances, improvements visible across age, income, and education, and political affiliation. Still, December's reading on expected personal finances is nearly 12% below the beginning of the year. Similarly, labor markets expectations improve a touch, but remain relatively dismal. So consumers are, there's modest improvement from November on a few dimensions, but the overall tenor of views is broadly somber. Looking closely at that left-hand side in terms of consumer sentiment, obviously it's gone down. This really comes down to who you ask. And consumer sentiment, as I mentioned, I believe last time I was here or I spoke, it's soft data, right? But it does really give a good sense of what the economy is feeling, what people are saying, and how people are kind of approaching or seeing the year. In terms of the unexpected change in price during next year, we're starting to see a little bit of increase. I think for many people, they're starting to expect the prices of goods and things to go up as we start heading towards the beginning of 2026. Next slide, please. Continuing on that trend, so spending did remain solid through Q3. Strength in services helped offset slower good consumption. A lot of this was pressured by tariffs related pricing pressure, as I mentioned, and higher borrowing cost. In terms of, and I'll talk about retail on the next page, but in terms of spending and savings, as I mentioned, the top 1% is really what's driving GDP and what's driving the economy forward, which is kind of, if you look at it from a different graph, it's essentially saying, oh, we're still good, we're fine. If you look at it from, the day-to-day person and the common man, not necessarily, right? In terms of personal savings, disposable income, again, back to that point, there is disposable income, but again, depending who you ask, you might get a different story. So just two very different narratives there to look out for as we head into 2026. And then can we go to the next slide? Okay, so in terms of retail, so September retail sales, the last major release came in September, rose 0.2% month over month, which is down in real terms according to our calculations, but following strong goods consumptions. Again, if you look at the right-hand side in terms of retail sales, this says August of 2025. Really, like food and services is the one area that has continued to grow. If you start looking at like sporting goods, hobbies, motor vehicles and parts, a lot of people have started to buy a little bit less. What you're getting is targeted spending. Essentially, people are spending the essentials. They're starting to see the rise in prices, so they're starting to cut back on the little things and being more targeted or a little bit more smart with their money and how they want to spend it. Next slide. And now to the fun part, the Fed. So this dot plot was actually released from September. So this is from the last FOMC meeting. There was a new updated dot plot that was released yesterday. Obviously, due to the timing of this presentation, couldn't get this on here, but kind of same story. One thing I want to focus on is 2025. So on here, you see 2 additional cuts. We know now that those 2 additional cuts did happen. In total, since last we spoke, there was 3 cuts for the year from the Fed. The range is now between 3.50 to 3.75. If you look at the dots, and I might have mentioned this before, those are the voting and non-voting members from the FOMC committee. That dotted or that dot that's kind of on the outlier where it says 2025, close to that 3%, that's a voting member, Marin. No surprise from him. You know, he's expecting more cuts. Yesterday, he wanted to see 50 basis point cuts compared to some of his colleagues. And then there was 2, I believe, was from Kansas and Chicago. I'm not going to mispronounce his name, but they voted for no cuts, right? So you're starting to see a little bit of separation within the Fed. Looking forward to 2026, if we were to look at yesterday's plot versus today's, there's still an expectation to see 1 cut. When that cut will come is very hard to predict. I'm certainly not going to predict that right now. It could come early in 2026, or it may come later through the summer. If I was a betting man, I would say it would come in a little bit later phases of it. I think for now, the Fed had made it very clear after yesterday, and Fed Chair Powell's kind of statement after the meeting was, for now, we're going to hold off for further cutting until we have more actual data being presented to us to make that, which comes as no surprise. Before they started cutting this year, the Fed was pretty much stuck on the porch saying, hey, unless we have, you know, set data that says you should cut, we're not going to. So I think we're going to go back to a little bit of area where they're sitting on that porch kind of waiting to see what happens. Another thing I want to highlight with the Fed is Fed Chair Powell's term does end in May of 2026. So I expect to see a lot of movement, a lot of outsized forces and outside influences as well in terms of who does become the next Fed chair, what direction the Fed takes. So I think 2026 will be a lot interesting in terms of Fed watch. Next slide, please. So now to kind of start wrapping this up. So we've talked about the unemployment rate, we've talked about the federal funds and PCE. Now to run out this market update. So the Fed comes out with their summary of economic projections and dot plot, which we just saw. This data reflects the most likely outcomes given economic data today, or as of their meeting. There is a new chart of this, but what you see on here present is the June projections in the lighter color versus the darker color projections for September. Few things I wanted to highlight and kind of still remain true even after yesterday. You know, policymakers did note again that they expected growth to be a little bit stronger, unemployment to be slightly lower, which did rise up a bit, and inflation to rise as well, which is totally expected at this point. In addition, they do expect inflation to return to its 2% target in the longer run, perhaps in 2028. On the labor side, projections were slightly nudged down, but you could hardly see that on here. Still, you know, overall, I would say with the U.S. economy, it's been very resilient this year. You know, there's been signals of a stronger economy to come, but of course, you know, the Fed has to remain cautious because of labor market risk, the risk of unemployment going up, the risk of inflation going up. You start getting into territory of stagflation. I'll tell you right now, I'm glad I'm not part of the Fed because I see a lot of hard decisions coming through for 2026. Next slide. And then now on the Treasury yield curve. So in terms of the entirety of the yield curve at the end of the quarter, so it shifted lower across all maturities over the past few months. The curve does remain inverted on the front end, but the degree of inversion, as you can see, is narrowing as rates are falling faster, or short rates are falling faster than longer rates. It's more reflective of the Fed's overnight rate. The Fed acts as an anchor to this part of the curve. But all in all, the environment still presents an opportunity, right, to lock in higher yields. The Treasury yield remains, you know, above historical average. Despite drops, it does despite drops, it does favor, us in this industry in terms of fixed income investors from a historical perspective. As of today, the 2-year was at 3.54%, and the 5-year was at 3.75%. So you can see on there for comparison, right? The shorter end has dropped a little bit, but on the longer end, if you're going out longer, still a lot of opportunity. If you look on the next slide, this is as of October 31st. Obviously, some of these have gone down since there was a rate cut yesterday. But overall, you're still seeing those elevated numbers, high threes, low fours, and even some cases high fours. I know there's been some new issuance that have come at still at the 4.5 and upwards. My main story here is there's still a lot of opportunity. There's still a lot of yield to be gained looking forward. So one thing to keep an eye on. And then next slide. Last slide here. Okay, so not going to read all this because this is all stuff we've kind of touched and I've really simplified today this morning. Going forward to 2026, right? So again, economy has been resilient, but there are slowing consumer spending. Kind of looking ahead, right? The labor market is stuck in that low hire, low fire approach. Inflation that remains stubbornly above the target. There is expectations that it will peak next year as tariff costs, finally filters through to consumers. And while inflation does progress, has stalled, growth risk rising. We expect the Fed to cut another 25 basis points at some point in 2026, which should bring another interesting topic to the story. But a lot of that is given, still to the significant tension between the Fed's dual mandate, which again, unemployment and inflation. I would expect the Fed to be very cautious about avoiding stagflation, but also being cautious in their approach and being a lot more dependent on the data that is to be released here in the next couple of weeks and in the early part of 2026. With that, I'll end there. And if there's any questions, I'll be happy to take a few.
Committee members, any questions for Robert? Sarah, go ahead.
I'm trying to formulate my question because I think the outlook for next year is extremely uncertain. We have a lot of change coming. If we don't extend the ACA credits or subsidies, that's like $35 billion the government won't be sending to insurance companies. That's not an insignificant amount of money. That also means people go without health care, which will also impact. And, all these individuals who are now struggling with prices, et cetera, like we're 70% dependent on consumption for our GDP in this country. I know that's not a question, I'll get there. But, we're also going to see a new Fed chair, like January or May, early part of next year, which, that person we should all assume is going to be a more political animal than we have right now. And we know what this administration's wishes are for what the Fed should do in the face of rising prices and inflation. So on here, my question is kind of twofold because I'm curious how PFM is putting outlooks together based on the fact that we're missing like 10 or more economic data releases from the federal government given the shutdown. They've not released inflation numbers. There are employment numbers missing. So how do you keep up on what's going on in those areas of the economy without the data coming out of the Fed? And then secondly, given all of this uncertainty, these things that are coming up, the prices, the financial condition on here is moving into the slightly positive green for next year, which I'm kind of surprised by. So I'm curious why that's the outlook and how it was developed given all of the data that we're missing.
Sarah, first of all, great to see you again. And great questions. I love those questions. So how do we keep up with data? From my end, a ton of reading every single day, even minutes before this meeting. But in terms of like kind of our internal, right, our portfolio strategies group, economists, so you can say, most of the data that you saw presented on here was at the end of the Q3, so September. So to your point, right, when the government went shut down, there really wasn't all of data. One thing that really surprised me is we kind of went based on a lot of like August numbers and the last things that we still had for certain. Everything else has really come in bits and pieces and really hard to put together. I'll be honest with you and honest with this board. It's becoming increasingly difficult this past quarter for me, going out to board meetings, finance committee meetings, talking about the economy, because you're right. A lot of the data is incomplete. It's in, so you're trying to piece it together to make a story, which has been difficult, right? I think our portfolio strategy group has done an amazing job of trying to piece some of that together. I know one way the Fed's kind of keeping up with their data, and we've kind of followed suit a little bit. Back in 2020, and I didn't know this, but back in 2020 for like unemployment, they relied on data from like Indeed, websites like Indeed, Glassdoor and things like that, which is very surprising. You would think we would have another source of better information that we can pull from, but the Fed relied on that. Obviously we're taking a look of those things and also just kind of going with the last actual formulated thought that came out of the Fed to then make, here's what we're seeing, here are the numbers. You asked about our outlook going forward to 2026. So let me go to that page. I think it was the last page, right?
Page 46 of the overall agenda, or page 14 of your presentation.
Yeah. So in terms of this, so this was as of September of this past quarter. I would imagine this is very different going into 2026. A lot of the points you made, I agree with in terms of the uncertainty going forward. I'm careful to mention stagflation, but I mention it because if you go on Google right now and talk about the economy 2026, that's one of the first words you're going to see. In terms of unemployment going higher, yeah, you're starting to see that. And in terms of inflation going higher, yeah, you're starting to see that as well. One thing on the unemployment side is that low hire, low fire type of approach that we've been seeing. Interestingly enough, there was a non-farm payroll release this past week, I believe, that came from BLS or the BEA. And in that, there was a mention that, even though jobs have increased, there's also been like a slight spike in hiring. But if you're a company, like, you're not necessarily firing people to fire them at this point. It's been turned into more of strategic firing in a sense. So that's adding more to the turmoil. And really what I'm doing right now is adding more to the fire at this point. But yeah, I mean, overall, I think it's becoming increasingly difficult to see. To your point, with next year, with a new Fed chair, there are political pressures. I think it's becoming increasingly difficult, too, to talk about the economy without talking about political pressures, political outforces going into this. But, that's the time that we're living in. In terms of, kind of like portfolio management and that side of PFM, the market's usually priced in for cuts. So a lot of these, 1 to 3, 1 to 5 securities, things like that they price them in, the market prices it in beforehand. But the outlook is if you got free money or free cash that you can definitely lock in, you should lock it in. You should lock it in. On that same breath, right? Always manage your money to what is the needs of the district, your city, your agency, and things like that. So I hope that answered your question. If you have follow-up, more than happy.
No, thank you.
Of course.
Committee members, Kurt? Jill? Vice Mayor? No, just one question, Robert. If you can go to staff, if we can turn to page 12 and 12 first and then 13 of his report. I think it was U.S. Treasury curves. If you can put that on the screen, maybe. Page 12. There it is. Here's a question, Robert. You said there's opportunity. And you heard me ask Sujata in January, just within a month, or a little over a month, we've got $160 million to reinvest. Those were 4 treasuries. What advice, strategy would you give our agency as we start to look at January 16th with all these uncertainties you're talking about in 2026? But I see that long-term curve looks good. And then you also commented in the other page, but go ahead. Can you answer that question?
Sure. One of the message I've been giving to a lot of our clients and people who have free cash is if you have cash and you can invest it out longer, by all means, you should, right? There's opportunity you can see on the yield curve. The longer you go out, the higher the yield that's going to be. In that same breath, and I think, Sarah, you know this part to it too, right? It's what are the needs of this district? What are the needs of this city? Because you can't forget about your cash flow. You can't forget about the cash that you might need. So my biggest thing with clients is, hey, if you know that you are going to need money in the next 6 months, well, you need to invest in something that's going to mature within those 6 months. If you know you have something that can go out longer than a year and there's still attractive yields, go for it. Another thing I remind people all the time, from a historical perspective, and I'm a big history buff myself and reading the economy from God knows when, the 80s, 70s, 60s, 50s, and all that good stuff. People forget, but if we go back 10, 7, 5 years ago, we would all be excited to get 3% on a lot of these things, right? People forget there was zeros. People forget there was 1.2. I hear stories all the time when I'm out at conferences and meeting with people, and man, I used to get excited over 2%. Well, the last couple of times we've been spoiled. We were up in the highs. Now that we're coming back low, everyone's freaking out. It's like, oh no, we're not getting as much. But reality is yields are still very attractive from a historical perspective. And again, if you got money that can put away, go for it. Sarah made a mention earlier about LAIF. I would say, right, there's also CAMP to it. But I'll add to this. LAIF, I'm pretty sure at this point might be outperforming CAMP. So as a fiduciary and as someone who's here to give you advice, LAIF might be the better option at that point in terms of what you can invest in, right? So that's kind of my 2 cents in it. I'll be more than happy to talk to Sujata in terms of what can't be done or kind of from our perspective and aid the agency, the district in the best way that we know how in terms of going over ideas and plans, even if it's with us or, elsewhere.
Thank you, Robert. Committee members, again, any questions, follow-up? No? Any public comment on this item? I see none in the auditorium. Wayne online?
No.
Okay, thank you, Robert. Move on to item number 4 is the action item, approved committee minutes, meeting dates for calendar year 2026. There's a motion to approve those 4 dates. Is there a second?
I would move to approve.
Okay, there's a motion by Supervisor Hagman, and there were a couple seconds. On one of those, I supported, I know on September 11th, I think is Rosh Hashanah in the evening, so I think we're okay. I think it starts at sunset. But that's my only, is there any public comment on this item before we take a vote? Wayne, do you have a comment or anything?
No one has their hand raised.
No, okay, thank you. Roll call, please, Jenny.
Supervisor Hagman, Vice Mayor Olmos,
Yes.
Board Member Padilla-Campos,
Yes.
Richard Dixon,
Yes.
Sarah Meacham,
Yes.
Jill Wynot,
Yes.
Chair Cacchiotti.
Yes,
Item passes.
thank you, Jenny. Thanks. And there other matters? Item number 5, other business. Committee members, any other business? Staff? No hands raised. Is there any public comment on this item? None in the auditorium, online, Wayne? None? No hands raised. Item number 6 is our public comment period. Members of the public can comment on items under our jurisdiction. Is there any members of the public who would like to comment at this time? Online, raise your hand. Or in the auditorium, please come forward. No one in the auditorium coming forward. Wayne, I don't see any hands raised.
None online?
None online, okay. Number 7, our next meeting date is Friday, March 13th, 2026 at 8 a.m. And with that, I'll wish everybody a beautiful holiday season, and this meeting is adjourned. Thank you.
Thank you.
Happy holidays, everybody.
Take care.
Thank you.